This is OwlUp, where learning happens in minutes, not hours. For a deeper journey, explore all our courses at owlup.co. Now, let's dive in. Welcome back to Chapter 3 of our series, Start Investing, Your First Steps to Building Wealth. In today's episode, titled Your First Investment, Index Funds Explained, we're going to break down what index funds are and how they can be a fantastic way to kickstart your investment journey. So let's dive in. Half of new investors skip the single tool Warren Buffett recommends most, and it isn't a hot stock tip. You're on your couch, scrolling past crypto memes and buy this now posts, while a quiet, boring option has quietly beaten elite hedge funds for a decade straight. So if the boring tool is that powerful, why doesn't everyone use it? Because most people's first investment is driven by hype, not by a system. You see a friend post a 200% gain, a viral TikTok calls a stock the next Amazon, or a coin suddenly trends, and it feels like standing outside in a storm, watching lightning hit random spots and thinking, I just need to stand where it strikes next. Index funds flip that script. Instead of guessing where the next bolt lands, you quietly wire your house with steady, reliable electricity. No drama, just power that stays on. This episode is about treating your very first dollar invested as a decision about habits, not headlines. Choosing low costs over lucky breaks, broad baskets over single names, and long-term math over short-term adrenaline. By the end, you'll know exactly what an index fund is and how to decide if it should be your starting point. Here's the twist most people miss. Your first investment quietly decides who gets paid more over your lifetime, you or the financial industry. A viral stock tip might feel exciting, but fees, taxes, and turnover are the slow leaks that drain your results while you're busy watching prices jump around. In 2023, the typical U.S. stock index fund charged just 0.05% a year. Many trendy funds or apps charge 10 to 20 times that. Over decades, that gap doesn't just nibble at returns, it rewrites your ending balance. This episode zooms out from what should I buy to how much of my own growth do I actually keep. At its core, an index is just a list with rules. Include the 500 largest U.S. companies weighted by size. Include all investable stocks in developed markets. Each list has a purpose, and each purpose quietly changes what you own and how your money behaves. That's why two funds that both track the market can feel very different once you're inside them. Some track a narrow slice, like U.S. tech stocks. Others cover the entire world. Some lean heavily on a few giants. Others spread exposure more evenly. Some rebalance daily, others less often. Those choices shape how bumpy the ride is and how quickly you recover after bad years. Zoom out to the big picture. More than $17 trillion globally now sits in strategies that simply follow these rules-based lists. That tidal wave of money hasn't happened because people suddenly stopped caring about performance. It's because, over decades, good enough, consistently, has often beaten brilliant, occasionally, but expensive. But rules-based doesn't mean automatically good for you. A few levers matter a lot. Which market slice? A total U.S. market fund will behave differently from a global fund that includes Europe and emerging markets. A bond index will cushion shocks differently than a stock-focused one. How concentrated is it? Something tracking the 100 biggest companies is more top-heavy than something holding thousands of names. How cheaply does it follow the list? That 0.05% average cost is just an average. Some funds still sit way above it. How closely does it actually stick to the index? Tiny differences in execution can add up over long stretches. There's also risk people gloss over. Indexes don't sidestep market crashes, they ride straight through them. In a deep downturn, your account balance can drop fast because the list of companies you own is dropping. The trade-off is that by owning many names at once, you're less exposed to any single disaster. The real decision isn't index funds, yes or no. It's Which rulebook aligns with my timeline, my tolerance for ugly years, and the amount of homework I'm willing to do? Your first choice here sets a default. Change is always possible later, but the earlier you pick a sensible rulebook, the more time compounding has to work with it. Think of 3 starter rulebooks you might actually use. 1 looks like a broad US list. You're mainly tied to the fortunes of companies where you probably already work, spend, and pay taxes. Another spreads across the globe, so your outcome leans less on any single country's politics or economy. A third mixes stocks and bonds in a fixed ratio, trading some potential growth for a smoother ride when headlines get ugly. Now layer in concrete tickers. A fund tracking the S&P 500 will move differently from one that owns thousands of US names, and both will behave differently from a world fund that includes Japan, India, and Brazil. None is the market. Each is just a different lens on it. Even the way a fund handles incoming cash matters. Some reinvest everything automatically, compounding behind the scenes. Others pay out regular distributions you'll see hit your account. Useful if you like visible progress, but it may change how and when you owe tax. As more money moves into index-style rulebooks, markets may feel different from the ones your parents invested in. Sharp drops can still hit, but recoveries might be driven more by flows into broad funds than by stories about single-star stocks. New twists, like ESG screens or direct indexing, let you nudge the rules toward your values or tax needs. Think less about picking winners, more about choosing which economic climate you're willing to live in for decades. Your first dollar doesn't need to be perfect, it just needs a job. Think in seasons, not days. Which mix would you actually hold through a long winter? More growth, more stability, or a blend? Over time, you can add new layers, like small caps or foreign markets, as your comfort grows. For now, choose one simple rulebook you're willing to live with, then let time do its quiet work. Start with this tiny habit. When you open your banking app to check your balance, tap over to your brokerage app, or download one if you don't have it yet, and search for a total US stock market index fund, like VTI, or an S&P 500 index fund, like VOO. Don't buy anything yet, just hit the Add to Watch List or Favorite button. Tomorrow, when you repeat this, click into the fund's Performance tab and glance at the 10-year return for 5 seconds. The goal isn't to invest right away, just to make seeing index funds a normal, low-stress part of your daily money check-in. This was OwlUp, your daily step forward. This series continues with more chapters on OwlUp.co. Visit OwlUp.co to access the complete course and continue your learning journey. See you there!